In this presentation, we will discuss some options for entering invoices and doing some tracking of accounts receivable while still having some formats of a cash basis system within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. As we discuss entering invoices into QuickBooks and tracking accounts receivable, we're going to note that that's going to be a deviation from a cash basis system. So in essence, once we go into that question, when we start to say, hey, I would like to create invoices within QuickBooks, but still remain on a cash basis, we have to realize that that's going to in and of itself take us away from a cash basis from that component, at least from that perspective with regards to accounts receivable. So in other words, when we enter the invoice into QuickBooks, QuickBooks doesn't see it as just like a form that we send to somebody. They see it as, of course, a transaction. So we're going to have to deal with that transaction within the system. If all we want is the invoice, then of course we can, once again, go somewhere else and create the invoice. However, if we want to track accounts receivable in QuickBooks, or at least be able to say, hey, this customer says that they didn't receive an invoice or something like that, we can at least see that the invoice was created in QuickBooks. So note, whenever, if we're thinking about doing it ourselves, if we have a client that's saying, hey, I want to go into the system and create invoices in the system so I can mail it, our first question is, well, why do you want to do that? Is it just to create the invoice, or do you want to track accounts receivable if we're looking for a cash basis system? If it's just to create the invoice, we might explore other options. If they want to track accounts receivable in QuickBooks, then we'll have to think of some kind of system that might work while still sticking with somewhat of a cash basis system, which means that we're not recording revenue until we get the payment, until we receive payment. Also note that if we have two different people in the system, so if we have, say, a client in the system entering invoices and we're going into the system entering the bank statement, we both need to know what each other are doing, because both of those things are going to affect the financial statements. So we have to have some kind of plan in place to put that in place. So let's think about a plan to put that in place. So here we are in our guitar lessons and equipment file. We're going to start off with the reports by going to the reports on the left-hand side. We'll take a look at our favorite report, that being the balance sheet and the income statement. We'll start off with the balance sheet. Selecting the balance sheet, scrolling up top, changing those dates from 01/01/19 to 02/28/19, January and February of 2019. If we run that report, then we're going to consider up here, you'll note that we don't have any accounts receivable here. And when we create an invoice, that's when we'll have to deal with accounts receivable. So that'll be the new thing we'll have to deal with once we create an invoice. We'll take a look at an example of that. Then we're going to create another tab looking at the income statement. We're going to right click and duplicate this tab. So we right click on the tab, duplicate. I'm going to pull the one from the left to the right, so that we have the balance sheet on the left and the new tab on the right, where we will make the profit and loss by going to the reports at the bottom, profit and loss report, scrolling back up top, changing the dates from 01/01/19 to 02/28/19, January and February 2019, run that report. So now we have up top, notice we have sales up top, and we have the expenses, of course, on the profit and loss. When we create an invoice, what's going to happen is sales is going to increase. And then on the balance sheet side, if we go to the balance sheet again, we'll have an account called accounts receivable. What we're doing now, of course, is waiting until we get payment, increasing the checking account, and increasing sales at that time. So in other words, if we have a situation where we bill the client, we did the work, we billed the client, under our cash basis, we're not recording anything until we get paid, which is going to be some later time. Under an accrual basis, we're recording revenue and accounts receivable at the time we send the invoice. So if the client or ourselves wants to create an invoice within QuickBooks, we just have to recognize that that's going to happen, that transaction is going to happen, and then what are we going to do? How are we going to deal with that? So to think about that, let's create an invoice and see what happens. So we're going to right click up top again, and I'm going to duplicate this tab again so we can make another tab to create the invoice. I'm going to move the one to the left from the left to the right. So now we have a balance sheet, a profit and loss, and the new tab where we'll create an invoice. So notice what we've done so far is we've always been going down to the accounting and entering information directly into the check register. What we're going to do instead is go up here to the plus item and we're going to enter forms, which is more of a full service type of transaction. Note that almost all of these forms is a transaction, makes a financial transaction. So anytime we do something with these forms, it's going to create a financial transaction. So we want to create this invoice so that we can invoice a customer. So we're going to create the invoice, and we're going to send out the invoice. We can even mail the invoice from here, which is nice. And we're going to say the customer is going to be Smith. I'm just going to add a customer, say we got to invoice this person, and save it. We would probably want to add detail. I'm not going to get into the detail of who the customer is and whatnot, but obviously if we want to send them our mailing address and whatnot, our newsletter, we'd want that. And then we could email it, and but we're not going to email here. We're just going to say that we're going to send this and mail it. Mailing address, if we had the mailing address in there, it would have the mailing address. Terms, we're going to say 30 days from the date it was created. And we're going to make it in March so that it's outside the 2 months that we've been working in. So it's not going to mess up our 2 months of data. So we're going to say 03, 05, 19, let's say, and then 03, 05. Whoop, I'm sorry. The due date will pop up automatically because it'll be a month later. And then we're going to say, what is it that we made? Now, first, we're going to need some items. Now, the nice thing about these items within QuickBooks is once we set them up, they'll always be there. So if we always do guitar lessons, for example, we can set up guitar lessons, and then we'll have a set price, and it'll always be there. So we could set up guitar lessons. We're going to say tab, and we're going to add this as a service item. It's not going to be inventory, but a service item. And we'll have to set up these items to create an invoice, but once they're set up, it's pretty nice. We can move forward and just always have that service item. So we'll say guitar lessons, and the category we'll keep the same. Description is going to be the guitar lessons. So I'm just going to copy and paste this in the description. And the rate we're going to say is, let's say $100. And then the income account that it's going to go to, this is the account that it's going to increase the income statement to. It's currently going to sales because that's our income statement account. We might want to make another one if we had different types of sales items. We'll just keep it in sales for now, just to keep it easy with that one income account. And then we're going to go save and close. So we'll save and close that. And so there is our guitar lessons. Now, every time I have guitar lessons, we can just give the quantity. We're going to say 2 here, and that'll give us the amount $200. So that'll be our invoice. Now we can send this invoice by email, we can print it, we can mail it, and we can also track the invoice information. So let's see what happens when we create the invoice to the financial statements. If we I'm going to say save and close over here. I'm going to say save and close. And then it's going to say okay, and I'm going to go back to our balance sheet now. And I'm going to make the balance sheet as of March now. So I'm going to make it 03/01/19 to 03/31/19. So March 1st to March 31st, run that report. And now we've got this accounts receivable, which is an accrual type of account. So now we've got accounts receivable we'll have to deal with. And then if we go back to the profit and loss, and we will run this one for March, 03/01/19 to 03/31/19, and run that report, we have this income now being recorded not when we got the payment, like we've been doing here on our bank statement. We didn't get any money yet, but we recorded sales at that point. So now we've kind of deviated from the cash basis. Now let's say we're going to make another invoice and just do this again. If I say the plus item up top, and we create another invoice, and we're going to say that this is going to go to Adam. We'll just say Adam is the name and save that. Again, we can have the email up top. Adam, we're going to have the date is going to be 3/5. We'll keep that. The due date will be here. And now let's say we're selling some type of inventory, like we're actually selling an actual guitar. So we bought the guitar, we're selling the guitar, not guitar lessons. Notice that pops up for us, guitar lessons here. But we're going to say this is an actual unit of inventory. So I'm going to just say guitar. I hit the space bar twice to not have guitar lessons. And then tab. And now I don't really, even though it is inventory, I don't really want to call it an inventory item unless I want to track the inventory within the system as well, which is another added level of complication that we probably don't want to do within the system. We'd want to track that under this cash basis simple system outside of QuickBooks, as we did or thought about doing the accounts receivable. So if you're looking at inventory and you want to just create an invoice and look at accounts receivable, then even if you're selling the inventory, you might want to just keep with the service item and then account for the tracking of the inventory on a periodic type of system, counting the inventory, and then we'll enter the inventory as we basically see it, clearing the bank statement in terms of a payment. Again, if you have a lot of inventory and inventory is a huge component, then you may want to consider some other system than just a cash basis type of system that we're looking into. If we want to track inventory within QuickBooks, that becomes a level of complexity. So I'm going to even track it as a service item. We're going to say that it is a guitar. So the category, it's going to be name is going to be a guitar. We're going to say the price is 300. Let's say 500. We'll say 500. We'll keep it going to sales, the same income account. And so we'll keep it all the same and we'll say save and close. And so now we got the guitar, and let's say we sold 3 of those. So it's 1,500. And then we're going to say save and close. So now we have that. If we go to our balance sheet then and refresh the report, now we've got accounts receivable 1,700. And we've got, if we run the report here, 1,700 in sales. So let's say that was the case, and then we got our bank statement here, and we got our bank statement, and the bank statement was showing these deposits. This, of course, is January, not March. But now on our side, we would have to say, okay, now you've got this information in the system. We're going to go on our side now and just record the revenue as we normally do by recording the deposits. And we'll note that none of these deposits line up specifically to that 1,700, and that's often going to be the case. In other words, if I go into the balance sheet side and I say this is how much people owe us, and we go into that account, we see that people owe us, there's a 200 amount and a 1,500. We may not, and that totals up to 1,700. We may not see a deposit for either any 3 of those amounts here, because we might have grouped the deposits in some other way, and we don't have on the bank statement necessarily the customer. So we don't know, who necessarily gave us the money. So we're going to have to come up with some system that we can enter this and clear out what has happened here and still be in a cash basis. So one way we can do that is we can basically say whatever's in accounts receivable, I'm going to wash out to sales, and then I'm going to record the deposits into sales. So in other words, there's 1,700. I'm just going to take it out of accounts receivable and put it into the sales account. And then when I get the deposit, I'll also put that to the sales account. And then once the two are cleared, it'll wash out. So in other words, we could do that with basically a journal entry. So we're going to go over to our third tab here. We're going to select our third tab, and then we're going to create a journal entry. Now you kind of have to do a journal entry here because you can't really use the registers because cash isn't affected, and the register for accounts receivable is it doesn't work quite the same way because you got to track accounts receivable. So we have to actually do a journal entry to do this. We'd go to the plus icon up top, and we want to look for the other and journal entry. So other and then journal entry. And then within the journal entry, you have the debits and credits, so it can be a little confusing, but there's only really 2 accounts that are affected, so it's not too bad. And if you go the wrong way, you can just reverse what we did there. So what we need to do is make accounts receivable go down, and we have to do that with a credit. So accounts receivable, we're going to say accounts receivable. We're going to make it go down with a credit. Now we could do this one by one and actually tie out to the customers, which would be the best way to do it. Or you can just say, hey, I'm just going to put this all to one customer name, which is basically the clearing account for accounts receivable. And that's what I'm going to do here. That'll be the fastest way, which is the simplest journal entry. So it'll be 1,700 in accounts receivable and we're just going to say this is to clear accounts receivable to sales to record on cash basis. So we're going to clear out the accounts receivable, and that's what this is going to basically do. Now we have to have a customer, so I'm just going to call this a clearing customer. So we're going to set up a new customer that's basically just there in order to clear out the accounts receivable. This won't match it up to the specific customer, but it'll make accounts receivable go down. And then we're going to say that the other side is going to go to sales, which is our income account. And that's the debit and the credit. So that'll take it, what that'll do is make accounts receivable go down to 0 and put it into sales. So let's see what happens there. If we say save on that, we're going to say that's done and then close this back out. If we go back to our balance sheet then and say run that report, now accounts receivable is back down to 0. If we go into the detail, you can see the 2 transactions are here. It went out. You have the detail of Smith and Adam, but then we decreased it by just going to one customer, which is going to be the clearing account with a journal entry. And then if we go back up top and we go to the profit and loss and we run that report, you'll note it goes back down to 0. So what in essence we've done is just reversed the transaction for the accounts receivable, but we did it all in one kind of lump sum to reverse it. And now when we enter the deposits from the bank statement, we can go just normal to our normal kind of transaction and enter the deposits as we normally would. We would go then to the deposits. So we're back to just our normal kind of process. And that allows us to use the QuickBooks to enter the invoices, mail with the invoice, to use the item list to track the invoices, and to give some tracking of the invoices that went out, although we're not tracking the payments that were received. So in other words, if we went to our sales tab up top and we take a look at our customer tab, we have the invoices that went out to Adam and Smith, but they're still showing that they owe us $1,500 and $200. And we don't really know if we have received the payment or not, because the bank statement's not going to tell us if we received the payment. So we're not even going to try to match that out under this system. All we're going to do is say, hey, that's the invoice that went out, and then we're going to clear it back out so that we can be on a cash basis system. So this system then will allow us to track the invoices that went out for Adam and Smith, allow us to enter the information into the items and to email the invoice and re-email the invoice if we need to. What it won't do is allow us to track the payment, whether or not we have received payment. That's still something that the client will have to basically check in on. They'll have to say, hey, I sent these invoices out. We checked that they went out. I know the invoice went out. We don't have the receipt payments on it. We can see deposits as they clear the bank statement, but we can't necessarily group them in the same way as the invoices were created in. And therefore, we're not going into the system to track the payments and match them out, as would be the nicest thing to do. Also note that we have this clearing account, of course, which means that we basically just reversed everything that happened. And that means that all the customer balances are always going to go up. They're never going to go down because we're not applying this balance to the customers. We're just saying that this balance is whatever it needs to be to make accounts receivable go back down to 0 to take us back to basically a cash basis system. We could make this transaction apply to these customers instead of another customer called clearing account, but that would take a little bit more work on the reversing entry. Doesn't provide a lot more benefit because we don't still know if we received the payment. It would just be taking these balances back down to 0 so that we can then enter the data on a cash basis system. For more accounting information and accounting courses, visit our website at accountinginstruction.info.